Have you ever wondered why the stock market, supposedly a place that creates enormous wealth, feels more like a giant casino swallowing ordinary people's hard-earned money? We study charts, chase trends, and trust so-called experts, only to get burned again and again chasing rallies and selling in panic. What's the real distance between us and investment masters like Warren Buffett? Information, capital, or some special talent? Today, we'll closely examine the book Buffett called the greatest investment book ever written, a financial Bible that can completely reshape how you see money. The Intelligent Investor. Its author, Benjamin Graham, known as the father of Wall Street and Buffett's mentor, did something incredibly powerful. He drew ordinary people a map to finally escape the fate of being easy prey. So this is not going to be an easy video. It will overturn everything you think you know about trading and show you why your past efforts may have been heading straight down a dead-end road to losses. Together, we're about to begin a journey of intellectual alchemy through investing. We'll fully understand the fundamental difference between investing and speculation. We'll meet a madman who can help you make serious money. And finally, we'll get the ultimate key to unlocking the door to wealth. Now, let's begin together and find the truly rational road to financial freedom. Part 1. Your first choice, walk into the casino or run a farm. In the last section, we said most people are sprinting down a dead-end road toward losses. Why is that road wrong? Because we chose the wrong map from the very start. Graham's first move in this book is to force us to face a huge crossroads and make the most fundamental choice. Will you build your wealth through speculation or accumulate it through investing? To make this choice clear, build a scene in your mind with me. Imagine that in the world of wealth, there are two doors. The first is glittering and grand, blazing with neon. Above it are two words, financial casino. Inside, people stare intensely at prices jumping across their screens, all trying to predict whether they'll rise or fall in the next second. They talk about tickers, rumors, and hot trends. Their goal is to quickly transfer money from other people's pockets into their own through price fluctuations. This is the world of speculators. They care about a stock's price, not the company behind it. The other door looks plain, even a little boring. Above it are the words, wealth farm. The people who enter this door are investors. They don't care whether vegetable prices rise by a dime or fall by 2 cents today. They care whether the farm's soil, the company's foundation, is fertile, whether its irrigation works, and whether it's planted with quality seeds that can create lasting value. When they buy a company's stock, they aren't really buying a ticker symbol. They're buying part ownership of the farm. Their goal isn't to profit from price differences. As farmers, they want to share in the harvest over time, the fruits produced by the company's profits. You see, speculators play a zero-sum game like mahjong. If someone wins, someone else must lose, and the total amount of money doesn't grow. Investors play a positive-sum game, like farming alongside an excellent company. When the company prospers, we, as part owners, receive a bigger harvest, and the total wealth keeps growing. Graham put it bluntly, 90% of our losses come from mistaking the casino for a farm, then using a gambler's strategy to play a game meant for farmers. So before learning any technique, ask yourself this basic question. Do you want to be a terrified gambler or a farmer with peace of mind? When you choose, deep down, to become a farmer, you've earned your first ticket into the world of the intelligent investor. All right, if we've chosen to be rational farmers, here's the question. Outside the farm, the weather is always changing, and the market switches daily between violent storms and blazing sunshine. How should we face this chaos? Graham introduces a partner who may be the strangest yet most valuable character in the investing world. How should we deal with him? In the next section, we'll meet this madman who can help you make serious money. Part 2. Your best partner and your worst enemy, Mr. Market. In the last section, we decided to become rational wealth farmers. But even the best farmer fears unpredictable weather. In the investment world, that weather is the market. To help us understand how to use the market instead of being swallowed by it, Graham created a brilliant metaphor that runs through the entire book. Mr. Market. Imagine that you and a business partner jointly own a farm. In other words, the company you invested in. Your partner's name is Mr. Market. But he has one problem. He's a wildly unstable person with bipolar disorder. When he becomes extremely excited and manic, he rushes up to you, red-faced, and says, "My friend, our farm is practically paradise. Future harvests will pile up, and then he'll name an absurdly high price to buy your share. What should you do?" A smart farmer calmly thinks, "If you're that optimistic and willing to pay tomorrow's price for what I own today, I'll gladly sell." But when depression hits, he becomes deeply pessimistic and comes crying, "It's over. The sky is falling. Our farm won't produce a thing." Then he offers a ridiculously low fire sale price, begging you to buy his shares so he can escape this miserable place. What would a smart farmer do? You'd think, nothing about the farm has changed. You've simply lost control of your emotions. If you're willing to sell me a quality asset for next to nothing, I'll take as much as I can. Graham's metaphor reveals investing's ultimate secret. The market exists not to guide you, but to serve you. Our biggest mistake is treating Mr. Market like a god. When he gets excited, we rush in. When he turns pessimistic, we panic and sell. We treat a madman's ramblings like divine investment orders. A smart investor always treats Mr. Market as an emotional servant to be used. You can ignore his daily quotes, but when he loses control and offers an extreme price, that's your perfect opportunity to profit. So from today on, remember your relationship with the market. It's the servant and you're the master. Use its madness. Don't let its madness control you. Now we know to treat the market as a servant, but one crucial question remains. How do we know whether Mr. Market's price is sky high or a bargain? What ruler tells us whether that price is high or low? This leads to the strongest foundation of Graham's entire investment system. In the next section, we'll learn how to build a bridge for our wealth that can never collapse. Part 3. The only creed of investing, building a bridge that can never collapse. In the last section, we learned how to deal with our crazy partner, Mr. Market. But to do that, we need an unshakable ruler to judge whether his prices are reasonable. That ruler is the core of Graham's investment philosophy, a simple but incredibly powerful idea called the margin of safety. To make it crystal clear, let's use another example. Suppose you're a bridge engineer building a bridge designed to carry 10 tons. That means any truck weighing 10 tons or less can cross safely. But you're a smart engineer. You know accidents may happen. Vehicles may be overloaded, and materials may naturally weaken over time. What would you do? You'd build the bridge to withstand 30 tons. Then even if a 15-ton truck crosses, you wouldn't worry at all because you know the bridge has a huge margin of safety. Now let's apply that logic to investing. The bridge's true value or intrinsic value is like its 30-ton load capacity. It's an objective value based on rational analysis of the company's earnings, assets, and future prospects. Mr. Market's price is like the weight of the truck crossing the bridge. Today it may be 10 tons, tomorrow 5, and the day after 20. The margin of safety is buying far below the true value you've calculated. For example, you calculate that the company is worth 30 yuan a share, but you buy only when Mr. Market offers 15 or even 10. That 15 or 20 yuan gap is your margin of safety. The margin of safety is your ultimate protection against mistakes. It recognizes that the future is unpredictable. Your analysis may be wrong, the economy may change suddenly, and a black swan event may occur. But with a wide enough margin of safety like that 30-ton bridge, you can withstand most unknown risks and keep your investment principles secure. Graham warned that any investment without a margin of safety, no matter how attractive, is essentially gambling. You'd be driving a 10.1-ton truck across a bridge rated for 10 tons, betting your life savings on its quality. So a smart investor's work comes down to 2 steps. First, calculate what the bridge is roughly worth. Second, wait patiently until you can buy it with the cost of building a bicycle. All right. We now have the mindset of a farmer. You've learned to dance with Mr. Market and mastered the ultimate weapon, the margin of safety. Your theoretical preparation is complete. But how do we put it into practice? Graham designed 2 clear paths for ordinary investors. In this final section, let's find out which one suits you. Part 4. Part 4. 2 paths to the finish line. Are you a defensive or an enterprising investor? We've built a complete system for thinking like an intelligent investor. Now we'll answer the most practical question. How does an ordinary office worker begin investing? Graham designed 2 very different strategies for people with different risk tolerance and experience: defensive investing and enterprising investing. The first path is for most ordinary people. It's called the defensive investment strategy. The basic idea is this: you're a hands-off farmer. Your goal isn't the highest possible yield, but avoiding major mistakes and earning a steady, satisfactory average return. The method is simple. First, diversify widely. Don't try to guess which tree will bear the most fruit. Spread your money across dozens of large, financially sound companies from different industries. An even better approach is to buy an index fund, which is like purchasing the entire large farm in one click. Second, invest regularly. Don't try to predict the best time to plant. Just invest a fixed amount every month. This is called dollar cost averaging. When the market is high, you buy fewer shares. When it's low, you buy more. Over time, your average cost settles at a reasonable level. The great strength of defensive investing is that it recognizes ordinary people often lack the time and expertise to pick individual stocks. It's an automated path to building wealth. The key is simply not to meddle. The second path is for the minority with enough time and energy who genuinely enjoy research. It's called the enterprising investment strategy. The central metaphor is this: you're an expert farmer. Through deep research, you search for undervalued, high-potential seeds of exceptional quality, hoping to earn returns above the market average. The method is much more demanding. Like a detective, you'll read financial reports, analyze business models, evaluate management, and estimate value precisely. Then you'll apply the margin of safety, buying when the price is far below the value. This takes enormous intellectual effort and emotional discipline. Warren Buffett is a top player on this path. Graham's advice is clear. Until you know which type you are, everyone should start as a defensive investor. First, make sure you survive. Then think about growth. The most dangerous people are those with defensive investors' knowledge, but enterprising investors' ambition. They often die charging into battle. All right, friends, our journey of intellectual alchemy is almost at its destination. We've learned that investing is about responding, not predicting, discipline, not courage. We should see ourselves as wealth farmers, treat crazy Mr. Market as our servant, and always hold firmly to the unshakable bridge of the margin of safety. So, how do you take your first step? Don't try to learn everything at once. Starting today, change how you look at a company. The next time you see a familiar name, such as Mutai, Tencent, or Apple, don't look at its stock chart. Ask yourself a completely different question. If I had enough money, at today's total market value, would I buy the entire company and hold it for 10 years? Once you start thinking this way, you've truly moved from being a gambler to becoming an intelligent investor. To close today's reading, here's a line Graham repeated throughout his book and the ultimate wisdom of his philosophy. The secret to investment success isn't how intelligent you are, but how disciplined you are. An investor's biggest problem, and perhaps his worst enemy, is very likely himself. May you soon set sail on your own rational path to wealth. Thanks for watching, and I'll see you in the next book.